talking of dates and timelines, before we jump into the charts, I should say we're recording here on the morning of Tuesday, July 12th, for a little bit of context. Obviously, these markets are very choppy and moving quickly. With that said, Holden, jump in, walk us through your charts.
Right. So choppy is absolutely the right word to use here. I mean, and it's not just stocks, it's crypto, it's commodities, everything's a little bit all over the board right now. And in order for us to look at anything crypto, the first thing that we look at any given day, as long as the market's open, is stock indices. We typically focus on the S&P 500 and the NASDAQ in order to kind of give ourselves a benchmark for a value play in the S&P and a growth play in the Qs. And something that's interesting that we've noticed over the past 4, 5, trading days for the stock market is we do have a bit of a counter trend, at least on the short term, for the NASDAQ, where on the chart that I'm sharing, you can see price is actually above the current downtrend, bumping into resistance at its blue 50-day moving average. Whereas if you look at the S&P, you're still well below the counter trend, you're still well below the downtrend and not nearly as close to testing your 50. So right off the top, that tells us, growth, at least on a very short-term basis, is outperforming value, which is indicative of increased demand for speculative investments. And that is a good sign for anyone that's looking to trade, swing trade or day trade or just any type of short-term plays on the crypto market. The first thing you want to see in a bear market like this is if there is a counter trend, you want the NASDAQ to be outperforming the SPY. So that is a good sign, at least for now.
It also infers that the anticipation is that with the commodity prices, and particularly the oil prices, have been coming down so much that in order to avert a full-on recession, that the Fed could pivot. And of course, when that happens, that's where the money starts going more into the growth stocks than in the value stocks. So you just have all these really perverse relationships right now, as Holden said, that everything is in a big messy soup because nobody really knows what is going to happen next, because it's a very hard thing to predict. So people keep grabbing onto things. Oh, yield curve's inverted. That means recession. Oh, the price of oil is coming down, but but the OPEC just came out and said that we expect demand to go up and we don't really have the throughput to go and produce more oil right away, et cetera, et cetera. So I think that's why NASDAQ right now is hanging on more than not just the SPY, but we mentioned, the Russell 2000 is the granddaddy of the modern family because that really represents the manufacturing industrial end of the U.S. So even if growth stocks perform a little bit higher at this point, that doesn't necessarily mean anything until we start to see some real internal growth here in the U.S. So I just wanted to give that backdrop here on these two charts.
Mish, you mentioned the Fed. We have a drinking game at Real Vision wherever someone says Scylla and Charybdis to talk about this conflict that the Fed is in. You have to take a drink. Let's talk a little bit about how you interpret and think through this sort of mutually problematic situation that the Fed has on the one hand of trying to tamp down inflation that's running way, way hot, and on the other, manage the recession risk. What are the indicators that you look at for understanding where we might be in that cycle, and how does it play into the broader context of market and portfolio allocation?
Wow, great questions. Well, first of all, so in terms of the Fed, yes, I mean, obviously, I think probably the best thing we have going for us when it comes to Jerome Powell is that he seems to be surprisingly honest about the inefficacy of the actual Federal Reserve in controlling the inflation because they thought it was transitory. So now and now what is he saying? That he's more focused on inflation because he doesn't think that the economy is going into a recession because of the labor numbers. And I think there's some validity to that because we still have 11 million jobs open and 6 million people out of work with people still quitting jobs. So that tells you that wages could actually continue to go up. And the labor market is not going to fall apart anytime soon, which of course is what the Fed really focuses on when they're looking at recessionary type of occurrences. So that puts us in back to the 70s, this stagflation environment that we have, even though people will argue now that there's no inflation, it's just recession. But I'm sticking with the stagflation. So now when we take a look at how that translates to trading and investing, cash definitely has to be probably one of the premier places to be right now. And of course, the dollar has just been exploding with all the problems in Europe. And two is that we're actually starting to look outside of the US and Europe for investments. We made a lot of investment into China. And now, and I haven't heard anybody talk about this, so this could be something that your audience hasn't heard before. We just started buying a little bit of South Korea. EWY is the ETF, because we believe that some of these Asian countries, and not just Asian countries, but particularly the Asian countries, are using the 1950s formula for the economy that the US used back then when we had our biggest growth period in the 50s and the 60s until we got to the nifty 50 that happened. And of course, that whole debacle with being monopolistic. So that's why we're looking at China, which of course is on its own problems with COVID, and South Korea. And in the US, been very careful. I've been playing this market very actively. Like, for example, we bought ARK over a week ago. But we've already taken some profit with just a few dollars in the trade, and we have a no loss stop. So I've been telling people, if you really want to sit positioned, you can't right now. You have to be very nimble. Even being short, you can get your face ripped off with one really good short covering rally, as we've seen over and over and over again. So stagflation means that. It means flat. It means stagnating. And I think the biggest problem people are having right now is getting that into their head, because they can't believe that a market could just go sideways. But all you have to do is go back to that period, right, Ash, in 1970s, and you'll see the market went sideways for years. And from its peak at the end of the 60s till 1982, when it finally broke out, in that 15-year period, it took you that long, if you had been investing at the late 60s, to get your money back and then make money. So 15 years now, everything goes much faster now. But
Right.
That's really why I think that at some point, I would love to see, I'm kind of praying for this in a sense, that we do actually see the decoupling of cryptocurrencies to what's happening with the overall economy and in the market. And I'm not exactly 100% sure how that happens, because everything we're talking about now is showing it's tied in. And if we're in a stagflation environment and crypto is part of that, then we'll do exactly what Holden just said, is we'll kind of chop around and stay sideways until something else develops.
Indeed, one of the key goals of cryptocurrency, particularly if you talk to advocates of Bitcoin, was to have this off the grid asset that was decoupled from equity markets, from other traditional, they would call fiat assets, what we would probably call capital market assets. But what's interesting is, as we talk about this, the correlation trade effectively goes to one. It's either risk on or risk off, depending upon what the Fed is doing with liquidity. But to come back to something that you just said, Mish, that I think is important, talking about the framework, almost this paradox that the Fed finds itself in with the dual mandate, which is generally defined as stable prices, usually in the framework of 2% inflation, and maximum sustainable employment. On the other hand, we have growth, which is currently in contraction, and we have this sort of de facto function of orderly markets, stabilization when you see volatility in equity markets. I think most people believe that the Fed is clearly looking at that as a gauge. How do you hash through all of those variables, which seem to be moving in different directions, with some of the historical correlations breaking down?
Yes, that's why I like to talk about the 70s, but then there's some real differences to the 70s. But in terms of Fed policy, there's a few things that I'm looking at right now. I mean, we talked about the inverted yield curve is like everybody, and every macro analyst in the world that I'm looking at on Twitter right now is saying, the last time we saw an inverted yield curve like that was 2007. We're going into a 2008 crash. I don't think so. I really don't. This isn't 2008. Yes, mortgage rates have gone up. And there may be a little bit of a slowdown in the housing market, certainly in areas, and particularly new construction. But even that's different. So here's what I think. If we go back again, in the 70s, you had the peak in oil during the oil embargo in 73. And then we actually, in the US, went into a recession. And so we may have a downturn or a slowdown, like you're saying, not necessarily as severe as it was back then. But what did the Fed do was they actually came back to being accommodative. And so I'm not sure how politics are going to fit into this, but if the Republicans actually wind up gaining back the majority in both the House and the Senate, it's possible that the Fed might become a little bit more accommodative, in which case we can have that next repeat, which is the market starts to rally, but can't go through the highs by any means. But what happens to commodities, that's exactly the green light they will need to go crazy, because labor, supply chain, all of that is still very much an issue, along with geopolitics. So the very long answer, to make it very short, is the Fed is probably the worst place to be right now. I would never want to have that job. And as investors, our job is really just to try to stay liquid as much as we can, have major risk management, same thing with crypto, and I'll let Holden get to that, but also watch the junk bonds and watch the high-grade corporate bonds, because they're signaling more that it's possible that the Fed will not necessarily be as aggressive as they have claimed to be, because obviously looking at declining precious metals, oil, and energy prices over the last few days.
Hey visionaries, thank you for tuning in. For more free crypto content like this, head over to realvision.com/crypto. You'll get early access to the most brilliant minds in the space to cut through the noise, get in-depth analysis, and get you ahead of the curve with unbiased insights.